Hello class, welcome to the next video lesson. This lesson we're going to be discussing Unit 6, which will encompass the Great Depression and the New Deal. As we've already been discussing the 1920s, we've already kind of briefed on what was happening after World War I, leading towards the Great Depression. Because as we've been seeing, different things keep leading up to different events that are happening within history. So, going off of that, we know that we just finished an age known as the Roaring Twenties. This was after World War I, when people came back from war, and things were finally starting to look up for a while. We had things such as the Jazz Age and the Harlem Renaissance, and different things that truly started to show and shine on America's prosperity and how things were moving forward in greater things. You know, this was the age of anything goes. We had behaviors such as bootlegging, the booze, the speakeasies. Women were changing and evolving in the time period. Their name is flappers. This was the short skirts and the short haircuts and the cigarettes and more of the rebellious stage. We also had dances such as at Charleston. We had Ford Motor Company was developed, and they brought on their Model Ts. Henry Ford, he began the assembly line, which is now allowing us to outsource much more greater needs, supply the great needs and demands of the people in America at this time period. This is the time period where ordinary people started buying things on something known as installment plans, and where the wealthy are starting to get even further. So we have these two margins. We have one, prices are dropping as eventually the supply becomes greater than the demand. And then we have, so the poor are getting poorer, but then if you look on the other side, we have the wealthy who are buying, investing into stock markets, and they're growing. So the gap between the poor and the rich is starting to truly see a great divide. And I want you to keep note of that as we go throughout the discussion today. The first thing let's discuss is Wall Street. This is the new future of the rich. This is now where Wall Street is this common name in New York in the financial district. It's located in the lower portion of Manhattan, just for more of a geographical sense. This is in New York, and that's kind of where it's headquartered. The Wall Street was where the stock market was, and this is where people went to get rich easy. This get rich easy philosophy started to come about. We had people would invest into a company as not necessarily how great the company was, but how much of a demand in the markets the company had. As we've already discussed on the margin, or buying on the margin, I want you to pause right now and kind of think, what does it mean to buy on the margin? Pause the video and then come back, but let me go ahead and answer it for the sake of time. I want you to know that buying on the margin basically means putting down money on stock and hoping that the margin, as time moved on, that the margin would encompass in the money that you owed until you broke even, and then anything past that you would start to see as a profit. I want you to think about right now, why was this established? Take time to pause the video. This was established so that the poor people could now become stock owners, and so they could get a say in the stock market and have this idea of what it meant to in the get rich quick kind of scheme. The third question says, what did this mean to the stock market crash for the stock that was bought on the margin? Take time and think about that. What it meant to buy on the margin was simply, as we said, it was put a down payment on. So in a sense, they weren't paying the entire amount of money that the stock actually cost. So what we saw a great deal was that when the stock market crashed, those people either the money they might have put down on that stock, they were hoping to break even and then gain money, but that might have been the only money, or they might have taken a loan out to get that. And it started a huge down spiral To say, for instance, if they took a loan for $10 into the bank, they went invested that $10 into the stock market crashed. Well, that $10 wasn't, first of all, necessarily theirs, it was the bank's, and it was a loan. So you see where obviously this is a trickle down effect, and especially how America started getting into quick debt and how things really almost they fed off one another. Also in the 1920s, I want you to remember, trying to bring back the idea of buy now, pay later. We were getting this idea from the alluring ads, enhancing the products, buying on credit was born. It was a sense, again, just to kind of close that gap of the rich and the poor, because since the rich had far too much and the poor had nothing, this whole buy now, pay later kind of started to come about. The hopes was that we could now get rid of these products would be taken off the shelf and put into homes, and eventually that the company would be giving the money back. How, obviously though, the buy now, pay later installment plans quickly add to the economy and their debt. So, besides the fact that it was they're priming the pump, they're getting the money into the economy, necessarily the same amount of money that they needed was not coming because they never did the second half. They never paid later. So the reality of the idea became basically a huge landslide of effects trickling down again into the Great Depression. So the question now is, why should a manufacturer go along with the installment plan? Well, first of all, because it's basically they were trying to simply feed the supply and demand. There was a huge supply for specific products, so they had to keep demanding it. By demanding it, they're providing jobs. People could now work in the demand to supply it. However, obviously it came to a point to where finally the American manufacturers were churning out so much that it was in a way the consumer goods that the people demanded weren't keeping up with the supply of goods in the overstocked warehouses. So we're seeing eventually where people, you can only have so many radios, you can only have so many Model Ts in your driveway. So soon the companies themselves started outsourcing too many products, putting them, overstocking them in the warehouses. And this is again where you start seeing these roaring 20s stop, coming to a standstill, coming to a halt. The roaring 20s were soon going to come and just come to a roaring stop. Now, in the 1920s, it was the output worker of the American industry. They leapt by nearly 2/3. However, this happened at a time when wages were not keeping up. So, besides the fact that outsourcing so much, the wages were still very low, which basically shows that the workers weren't gaining any more money based off the profit. It was happening. The manufacturers themselves were the ones who were making the profit, and again, just growing that gap between the rich and the poor, and eventually, buying on installment plans. This gap just keeps on growing. So I want you to take note of this pie chart and kind of look, and this is talking about the economy in the late 1920s. If you're looking at income distribution, if you notice, 65% is under $2,000. Now, it's only a small 1% that has $10,000 or more. So the idea that everybody ought to be rich was not necessarily true, because in reality, about 200 large companies controlled nearly half of the American industry, and only 1% encompass for nearly over half of the world's economy as well, America's economy as well. Too many goods were being outsourced. Farmers, they started having their own issues with prices falling, farmers unable to pay debts, and they began to get in their own kind of trouble themselves. Then eventually, on Black Tuesday, which happens to be October 29th, 1929, Most people sold their stocks as a tremendous loss. The stock market crashed. This collapse in stock market is known as the Great Crash, and as a whole, take note that it signaled the beginning of the Great Depression. So the Great Depression starts at the end of 1929, and it rolls on through the 1930s. Overall, the total losses of one of the effects of the Great Crash was nearly $30 billion. The Great Crash was a part of a nation's business cycle. It was this idea, though, people, they didn't think that it was a Great Depression. They thought it was just part of a cycle. This was, economies, they go up and they go down, and they were assuming that this was just going to be a downturn. If you'll look at this good diagram, I think it does an excellent job of really showing how the effects of the Great Depression, the Great Crash in 1929, truly didn't just affect A, America, and it B, how each thing kind of trickled down to the next. And if you see, it starts with the Great Crash. The crash happens. Investors, they either get scared or they have already lost their money. With that happening, people lose their jobs. They can't have enough money to buy things. So obviously, this consumer, spending drops. Workers are laid off. Businesses are cut. Investments are done. And through that, the banks, there was the bank runs. They tried to invest. They wanted to get all of their money out of the banks if the banks hadn't already loaned it out. And through that, you go into the world, Overall, we were outsourcing other countries who we were helping out through World War One. Investments to Germany. Now we're not able to send money to Germany, send money to European nations, or even take in imports and exports. So the Great Depression, despite the fact that it was only in America, since America was a world power, it eventually ended up hurting the entire economy of the world itself. So we're going to continue on and look at the stock market crash from riches to ruins. Basically, this was many families basically lost everything. Some people started committing suicide because they were so hurt and distraught, and men, started feeling as failures. Millions of people who never owned a single stock lost their jobs, farms, and homes simply based off the fact that the people who lost their stocks, lost their jobs through the stock market, they lost the companies who housed these people to live, who allowed for the farms, and they took the profit from the farms. So this was truly a trickle-down effect from one issue after another, and how they all linked together. The crash also triggered a much wider long-term crisis, and this is known as the Great Depression. The Depression had a ripple effect that hurt the economies of other countries as well. If you look at this chart, you'll see how the Great Depression didn't necessarily start here in 1929, but it was slowly but surely. It was just a slow kind of rise of unemployment, starting around, I would start saying that 1925 we started coming to a slower standstill with the Roaring Twenties, until obviously in 1929 it wasn't just that it happened, but the Great Depression truly impacted the employment factors by a sharp increase in unemployment, because from there obviously it skyrockets, nearly to 12 million people being laid off. Here you'll see kind of how it affects the farmers, how it went from, price in bushels, prices dropped. They started dropping around 1925, and then 1929 they plummet. Then eventually, around 1933, they somewhat start to rise, but then right around there, we hit something else that we'll discuss in a little later. Going on, you'll see the stock market, the stock prices, how they come up. 1929 happens, and it's a spike downward. Please go to video number 2 to continue this Unit 6 in the Great Depression and New Deal, where we'll be discussing the president who was in office during this time.